Welcome to the first episode of Investing Outside the Box. I'm David Harris with Alternative Investment Advisors. And after more than 30 years advising high net worth individuals and institutions, I've learned one thing. True opportunities often live beyond the traditional stock and bond markets. This show is designed to give you insight into alternative investments, private equity, real estate, hedge funds, and other strategies that don't always make the headlines but can play a powerful role in building and protecting wealth. Each week, we'll explore unique opportunities, interview thought leaders, and challenge conventional thinking so you can make smarter, more informed decisions with your capital. Let's get started.
Welcome to Advisor Insights, where we ask the difficult questions to financial insiders to help empower investors with the insight they need to invest like a pro. My name's Rob Souza, and today we have the privilege of having registered investment advisor David Harris, the owner of Alternative Investment Advisors, who has more than 30 years of experience helping people understand the value of alternative investments. Welcome, David.
Thank you, Rob. Thank you for having the conversation today.
So let's jump in and let's start off by having you help us understand what is the difference between traditional investments and alternative investments.
So probably the biggest difference between the two is that alternative investments tend to be non-correlated to the stock market or the bond market, which means that if the stock market is dropping 20%, the alternative investments you have will probably not move at all. So it's a place where you can really count on the ability to not have a lot of volatility.
Okay, well, and you just said it, volatility. Does that mean that alternative investments are less volatile, and why is that the case?
Well, typically your alternative investments will be less volatile because they're not traded on a daily basis. They're really long-term investments, usually anywhere from 3 to 10 years out, most likely 3 to 5 years. So we find that the risk or the volatility is not the same as the stock market because these are a lot longer term assets and don't trade on a daily basis.
Okay, so longer term obviously mitigates risk over time, but are there guarantees that also help mitigate that risk, or is it just time horizon? Because if you invest in the S&P, which is a fairly safe index, and you're doing it over a 10, 15-year period of time, it's a pretty stable index with a pretty competitive return. Why would somebody want to consider an alternative versus something that's very familiar and something they can track on a daily basis?
Well, one of the great things about alternatives is that they have a backing, an asset backing, whether it be real estate or a life insurance policy or a heavy metal. There could be a lot of different ways to actually have a good guarantee that you're going to get your money back. It's not 100% guaranteed, but there are usually assets in the alternatives we work with that back up the asset.
So I know there's lots of different alternatives, and I think the biggest challenge that people have is getting comfortable with the idea of an investment strategy that they haven't heard of. What reassurances do people have about the variety of alternative investments are available, and how do they vet the safety and authenticity of those opportunities?
Well, that's a great question, and it is really important. So the first thing we do when we start to look at an alternative investment is that we will run it through our analysis and do our due diligence and ask the hard questions to the sponsor, look at their financial statements and look at the deals that they've done in the past. And so we'll really dig down deep on that. But then as a second step, we will get third-party due diligence. So there's companies out there that will go in and do the same thing I would do, and they might look at it a different way than I do. So having 2 or sometimes 3 or 4 due diligence eyes looking at an investment in the alternative space is, I think, a really good thing for the client.
Well, that's a really great lesson to learn for any investor. Never take the word of one particular advisor when making suggestions about any investment opportunity. It's always great to get the opinion of, and I'm going to let you fill in the blank. How do we find independent assistance from a third party source? Where do we go to find those types of people who have a fiduciary responsibility of what's in our best interest and not the investment's best interest or the sponsor's best interest?
So we work with these other companies to make sure that they provide this type of diligence. Otherwise, it won't make our list of sponsors that we want to offer a product, because we want to make sure for sure that we've done our homework, that somebody else has done the homework, and that it is got a great chance of making it to the end and making the client a lot of money or income or tax savings, whatever it is that they're looking for.
Okay, and you said sponsor. So help us understand from an investor's point of view. Sometimes these terms get confusing, but when you refer to sponsor, can you explain what that means?
So the sponsor is the company that is putting out the investment. So if it's a multifamily real estate deal, the sponsor is the one that put together the deal and is offering it out to advisors and brokers.
Okay, and I'm also assuming as an accredited advisor, you have fiduciary responsibility. And then if they find another third party that has fiduciary responsibility that's not affiliated with the sponsor, you're suggesting that that can help people vet an alternative investment opportunity.
Right. What's important to know is that we work on a fee basis. We don't get commissions. So we have to do what's in the best interest of the client. And if that means that we have to do our own due diligence and we're only working for the client, they come first.
Got it. So help us understand now as we dive into like a variety, because alternative investing is a vast space with lots of confusing opportunities that people are trying to make sense of. Can you give me some highlights of some of your most applicable favorite go-to alternatives and give us samples of what those investments are?
Okay, so let's look at structured notes. Structured notes is basically where you're working with a banking institution that is underwriting a note. But what's great about it is that you can get a note with downside protection. So let's just say 20%, but you also get to participate in the upside. So let's take NVIDIA as an example. Right now, NVIDIA is trading near the highest point that it's ever been. It's worth over $3 trillion. Well, instead of going and buying the stock and potentially, let's say the day after they come out with earnings and it drops 30%, that doesn't make you look very good. And then it makes you second think, and so, well, how long will it take for them to earn that back? Well, you can set up a structured note that will give you 30% or more, just depends on, there's so many different ways you can set up these notes. We do it for each client individually, but we can give you the amount of risk protection that you need on the downside, but still be able to participate in most of the upside.
Help us understand that 30% when the S&P is averaging 8. How can you get or even show people investment alternatives and then legitimize a potential 30% return?
Actually, we're talking more about 30% downside protection.
Oh, got it.
Okay. All right. So yeah, but the upside, if sometimes you can create a note, and a lot of these notes are based on the volatility of the underlying stock, but you can give yourself sometimes unlimited upside potential with downside protection.
Got it.
So it just makes so much sense to, well, why don't I just do this where I get some protection instead of being in the stock? And that way I get the best of both worlds.
Sure. For the average investor, help us understand what is a note and structurally, How are they putting that together, and what's the function of that that gives you that extra protection?
We don't want to get too complicated, but basically what is happening is a bank like Chase or JP Morgan or RBC, they're putting together a note. They make a note and it's backed by the credit of that bank. So that's an important thing to know. It's like having a bond with that bank. If you're comfortable enough to just own that, then that's the first good start. But what they do then is they put together this note and they'll go out and buy options to protect positions and to give you potential upside. And then they just put it all together. They put out a prospectus and they allow registered investment buyers to go buy those products. And it's been something that I've been doing for years that's been working out great for clients.
Yeah, it's fantastic. Sounds a little bit familiar to Rich Dad, Poor Dad. Robert Kiyosaki, who says, his rich dad at least, says, the rich man is the one who learns how to leverage other people's money. And when you do that, you can exponentially grow with less risk. And because it's collateral based, right? You're leveraging assets, but not using your own per se money. You're using your assets as collateral.
Being a fiduciary, we really explore what the client's needs are. We want to make sure, one, that they have their risk covered. Two is returns. And so what we want to make sure is that it checks all the boxes. How risky do they want to be? How much return do they need? Do they need income? Do they need growth? So all these weigh into decisions that we will help the client make to find the perfect portfolio and diversify. Diversification is a great tool that we use too. We won't just necessarily go out and buy one alternative for a client. We'll buy multiples so that we make sure we're covering our bases. Remember, don't ever put too many eggs in one basket. So that's our philosophy there.
So what would you recommend people when they are considering some sort of an insurance alternative? What would you tell them the one or two most important things to consider before moving forward?
I would say that the most important things is, what are you looking to get from the investment? So is it with insurance, you can get tax-free income. You could also be relying on the death benefit. It just depends. Do you want to make sure that your taxes are covered in the future, or that your family will be set up for life if something did happen to you? Or are you doing the insurance to get a tax-free income? Because you can do that. A lot of people don't know that. Or you can actually do a mix of the two. So it really depends on each individual's case at the time.
So it sounds like it's very customizable in its design. It's not a one size fits all, it solves all problems. You have to prioritize what it is that you want it to do, and then it can be designed for that specific set of values or benefits that somebody's looking for in an investment.
Typically, no two portfolios are going to be the same. And that's important because I know that as an advisor, when we are just doing traditional investments, we tend to have our models and everybody's put into a model. So it's like putting them into a box.
Yeah.
But with the alternative investments, it's a little bit different. And we're trying to build something that is non-traditional and make sure that we've done the due diligence and still fits the round hole with a round peg, to make sure that the client is getting exactly what they were looking for.
And I want to address one last alternative today before we wrap up, because we, like you said, don't want to get too deep in the weeds. We want people to be able to feel like they understand more and not walk away with more questions. But I do want to touch on real estate and opportunity zones, because I think it's intriguing that it's not just an alternative, but there's also some incentives that are provided by the government. There's grants, there's certain investments that are great possible investments because of the current legislation. And so, how does legislation play a role in making an alternative more appealing than a traditional investment?
So you mentioned real estate. Real estate is great. And just depending on how it's bought, probably the same goes for oil and gas at this point. Now, with the big, beautiful bill, we have 100% bonus depreciation. So, what it's going to do is it's going to mean more money in your pocket when the investment's finished. And so, real estate, again, the ones we invest in are backed by hard assets. And opportunity zones is another way to invest, which, I'm going to be talking about these down the road in my podcast, Investing Outside the Box. But opportunity zones is a way to defer or eliminate taxes on a capital gain. And what's great about it is it could be a short-term capital gain or a long-term capital gain. It could be art, collector cars that you have. It could be stocks. It could be options. It could be things like that you would never think. But if you're going to have to pay tax, the opportunity zone is a great way to defer or eliminate the tax, and you get a big, big bonus at the end.
So fascinating. People are so creative, and new investments are coming out all the time. And that's why it's so valuable to bring somebody like you on and ask those hard questions, educate ourselves, because there's so many opportunities I think investors are just not aware of. And things pop up because of legislation change, new opportunities arise. And so it's super helpful that you've joined me today and kind of give us, really, we just scratched the surface. And that's obviously why you're launching your, what is it, Invest Outside the Box? Is
Investing Outside the Box.
Okay.
A weekly podcast, and we'll probably have supplementals. We're going to be doing series on tax savings, on real estate, just all different types of investments that clients might not have ever heard before. And we're really excited to bring that. And there's some really large companies doing these, but people just don't know about them because it's not in the mainstream. And I think what we're going to try to do is drive it into the mainstream and make sure that everybody knows what we're doing and how we can work with them to make sure that they fulfill their investment goals.
And if an investor is looking for a competitive edge or something different to try and give them the edge they need. And the edge doesn't necessarily mean returns. It can mean guaranteed income. It can mean tax savings. It's whatever edge they're looking for, right? But I think what's interesting about alternatives and why I can't wait to watch your show is because in alternatives, there's a lot more options for people to address the most important concern to them. And so instead of just having a portfolio in the stock market and a mutual fund, now they have all these other choices. But the only challenge is now they're going to have to tune into your show and they're going to have to learn what those options are so that they can figure out which direction do they want to go in considering the different alternatives that are available.
The important things to note is that alternative investment advisors, that is our focus. We are not looking to invest in traditional assets. We are going to focus only on the alternatives. It's a space that we know that we want to make sure that all our concentration is on that one area, that we do the best thing for our clients.
Well, I appreciate you taking the time to join us today and answer some of the questions as we start this conversation. I can't wait for you to continue the conversation in your weekly broadcast. And where can people go to follow you? Obviously, we have some of your socials available up here at Alternative Investment Advisors. They can also check you out on YouTube, I think, under the same.
You can find us at altsadvisors.com, altsadvisors.com, altsadvisors.com.
Fantastic. And if you are out there and you have questions and you just want somebody to give you an answer that can point you in the right direction, I encourage you, reach out to David. He's always available to take a quick call, learn a little bit about your situation, your priorities, and feel free to reach out and get some free advice. What do you have to lose? In the meantime, we thank you for joining us, and we'll see everybody next week for Advisor Insights.